Hi, everyone. I'm Adrian Helfert, CIO of Multi-Asset here at Westwood. We wanted to talk to you about some of the volatility that we have seen in markets recently. Certainly has been interesting, to say the least. There's other words that we could use for this, and usually it's not associated with fun. We've seen downturns in experience. One thing I'll address is certainly number one, the Fed. The Fed we saw this week opine with a three hike scenario, 75 basis points. We're at five hikes on the year right now. We expect to see 9 to 10 hikes on the year as they combat inflation. One thing interesting that we saw from that was similar to the last time that they hiked, we saw immediately the market responded with more positivity. The market responded with more positivity, I believe, because inflation is the name of the game. It has changed a little bit and is continuing to change from this concern that the Fed is going to break the back of inflation at the expense of the economy to the market, consumers, others responding that actually it is really important to combat inflation because it has deleterious effects on consumer balance sheets, on income, on purchasing power, on your ability to service debt. So please, the Fed is being told, do combat inflation. And just before the Fed came out, we had that June 10th CPI or inflation that was a game changer. It was a game changer for the markets and for the Fed psychology. Fed Chairman Powell said as much of that took them from being two hikes to three hikes very quickly. It beat expectations. So we're seeing that as a result. We often talk about when the Fed hikes or goes through a hiking cycle, that is pulling the punch bowl. That means that economic activity or prospective economic activity is likely coming down. And we're seeing that over the course of the year, where we started out the year at significantly higher expected GDP growth. We are now considerably lower. One thing that has been topical is the Atlanta GDP tracker, which is a real-time GDP tracker or expectations, is down near zero now. Now, consensus is still significantly higher. Fundamental expectations of how much economic activity could be generated is still around 2.5%. That is more reasonable for the entirety of 2022. But that's not high. That's in line with long-term averages. And of course, that leads to the question of when there's a zero out there, people start thinking about the R word, about recession and the possibility as such. The consensus right now is around a 30% chance of a recession. The yield curve doesn't tell us that. And that's the usual prognostication factor of when the difference between the 10-year yield and the 2-year yield goes to zero or below zero, then a recession is coming. We're not there yet. We are around, by that expectation and the Fed's expectation, around a 3% chance of a recession in the next 12 months. That's too low. At the same time, we don't see an over 50% chance of recession. And now when you look at markets, they are telling us that, yes, number one, we're going through a Fed hiking cycle, but it's already pricing in the expectation of a Fed cut to interest rates by mid-2023. That's pretty amazing. We're talking about another 75 basis point hike maybe coming at the next Fed meeting. Yet when I look forward, I see the prospect of the Fed is going to be cutting rates. They're going to be doing that because this is such an inflation-driven environment that they are concerned about, as I say, the deleterious effects of that on purchasing power, activity, and debt. And it is going to push lower economic growth. When inflation starts to come down from supply chain driven cessation, from lessening geopolitical concerns, from energy prices hopefully coming down at some point for consumers, then the Fed is going to be forced to support economic activity and to provide some stimulus back to markets. So that was certainly something interesting we saw this week. Maybe the most interesting thing out of all of the conference that I saw was that Fed Chairman Powell was talking effectively about unemployment might need to go higher. And a normalized job market might actually be a little bit healthier for earnings. He didn't say that quite as such, but that was the read into that of a normalized job market means an unemployment rate that's a little bit higher. That potentially means that wages, because wages are going up above core inflation. That's a positive thing actually for purchasing power, but it can hurt corporate wage impacts on their margins. And we need good earning cycles for corporations to continue to spending, for that virtuous cycle to continue of, I feel good, I can walk across the street and get a job, and so I purchase things that are discretionary activities. So corporations buy more machines and hire more people to manage the machines, and thus there's a virtuous cycle. We need good corporate margins, good earning cycles for that to continue. I think that's what Fed Chairman Powell was saying. We've seen mortgage rates go up on the back significantly of this rising interest rate activity. Mortgage rates now have gone up such that the median home price is up significantly, yet the median home payment for the median home that is a 20% down is up 111% over the past year. That means that that house that you were looking at buying and you calculated within your budget that you could afford this house, maybe you can still afford this house, but you're going to have to cut out consumption in other areas to do so. You squeeze the balloon and the bubble comes out somewhere. And that could happen in consumer purchasing, but mortgage rates are going up, and they are going up dramatically for as a payment because of house price rises on a median home price, and because of the impact of a rising mortgage price, where you might have been locked a year ago at 2.875 or 3%, it's 6% now. That's the prevailing rate. That could have an impact and will likely have an impact. A second level is that markets are appreciating much of this. Markets understand much of this already, which is why we saw a downtrend this week, which is why the S&P 500 is in bear market territory. It's down 22%, a little bit over that on the year right now. The home builders are down even significantly more. So how much of this is already priced in? A significant amount is. Multiples, or price to earnings multiples, have adjusted significantly. They are not at lower historical bounds, but they're back near medians for long term when you look at where we are. So there's been a significant drawdown in the understanding from markets of future economic activity. And as I often say, markets don't just reflect what's happening now, markets reflect what is happening forward. So it's behooving on us as investors to say, okay, there are some significant negatives concerning right now. Gas prices are above $5 in many states. Home prices and your home mortgage payment has gone up significantly for the median home price. We're seeing consumer sentiment that has come down. Yet markets have reflected much of this. The upside relative to the downside of markets from here, that skew is changing. There is some upside capability. We do need the possibility of energy prices to come down some to help consumer expense on that front. It wouldn't hurt for us to see corporations have improved margins and predictability on margins as far as wages and input cost. A lot of that spells supply chain right now. We need the LA port system. We need the geopolitical concerns to have reduced concern around being able to get goods out when needed, to when you go buy that chair at Home Depot, to not have to wait 6 months for it. We need reduced supply chain concerns to reduce inflation. So it generally is an area where we are seeing elevated fear in the environment right now. I don't think we're at max fear. We could see further drawdown from here. Bonds are becoming more attractive, as generally a 10-year U.S. government treasury does reflect by its yield expected economic activity. Yields are above that right now. So we are looking that bonds are becoming more attractive, and certainly they are becoming more attractive relative to dividend stocks. But at the same time, fear is still elevated. We could see more of this before we see the end of the pain that we have felt certainly this week. Generally, on a historical basis, it pays to wait for the Fed to stop hiking, to stop its cycle, and that's not far away, we think. And that's what the markets are telling us now as well. As I said, we see a cut by mid-2023. So there is a light, it's just not here yet. We look forward to your questions. Thank you for listening so much. Any questions or comments are certainly welcome, and reach out to us. We look forward to seeing you again soon. Thank you.